Hey, we're joined by Riot. Phil, thank you so much for carving out this time to speak with us today. Would you like to briefly introduce yourself for people that are kind of call it unfamiliar with the name?
Sure. Yeah. Phil McPherson, Vice President of Capital Markets and Investor Relations at Riot Platforms. I have been at Riot a little over 3 years. I was the eighth employee here. Now we have over 500. So kind of been here for this record run that we of growth, both from a computing standpoint and employee standpoint. Prior to Riot, I was the CFO of an oil and gas company out here in Southern California. And prior to that, I spent 15 years on the sell side as an E&P exploration and production research analyst. So I've been kind of on all sides of the table, if you will.
Well, sell side experience is certainly really impressive. So here we are. We're heading into the halving, and I think there's certainly increased focus on Bitcoin given the recent run. At least in my memory, I can't recall a time when Bitcoin was acting so positively ahead of a halving event, and it's bringing all kinds of hash rate into global hash. I guess, a couple of months ago, the industry was calling for 25 or 30% declines post-halving. That number has been shrinking daily with the run-up in Bitcoin, which appears to be sustainable. Now we're thinking that could be closer to 15% as far as a hash rate reduction. What are your thoughts there?
Yeah, so I mean, as everybody knows, the halving happens every 4 years. The prior halving cycle, if you look at the data, Bitcoin tends to perform really well post-halving. And I think the ETF has kind of pulled some of that price discovery forward a little bit faster, which we'll take. That's bullish for us. Regarding hash rate, I've been a little bit of a contrarian, I think, in the industry. I've been saying for about 6 months that I didn't think a lot of hash rate was going to come off. That wasn't as much predicated on a bullish forecast on Bitcoin price. It was because the network grew so much in 2023. So the global hash rate in 2023 went from approximately 250 exahash to 500. So when you think about that percentage of what's going to come off, all of that growth last year was brand new machines. So that part you can't even think about as far as coming off. Those are all the latest and greatest. So you have to think about 250 exahash, which is where we ended 2022 at. And so I think of that 250 exahash, there might be 10% of that, maybe 15% of that is older machines, S9s, S17s, that have a joules per terahash, much higher than, say, 30, 35. But with Bitcoin prices where they're at today, even those machines, if you have the right power costs, can still generate money because they're already paid for. So I'm kind of in the camp that I don't think you're going to see this large decline. And if anything, I think with the recent increase in the price of Bitcoin, it's opened up the capital markets to a lot of miners. And so they're going to be able to buy new machines to replace those old miners. And what's going to happen is those older miners, might have been, just say rated at, 30 or 40 joules per terahash. You're going to drop into the low 20s, and you're actually going to increase your computing power. So rather than a decline, we were looking at a site that had a bunch of old S17s, and just by putting in new miners, we could double that site's mining capacity without using more electricity. So I think the cycle is going to be more hash rate, but I think post-halving, we're not going to get this big decline like we've seen in prior cycles.
Yes, certainly. And there's been a large increase in, call it, retail demand for Bitcoins, given the activity of the ETFs. So certainly we're positive on the underlying coin moving forward. I guess when you're thinking about, call it the broader global mining pool, what percentage of that do you think the public miners represent? And how much of that do you think is, perhaps nation states that are undertaking Bitcoin mining as a part of their public policy, either publicly or privately?
Yeah, so the public miners are around 20-25% of the total global hash rate. We're seeing, people in the Middle East, Saudi Arabia, UAE, building mining sites. We're seeing stuff in Indonesia, which is new. We're seeing stuff in Africa, which is new. The older players, which was Kazakhstan, Iran, Russia, they've kind of been there. I think some of the nation state growth last year was fueled by one manufacturer, Bitmain, and they had too many machines and not enough. The public markets were kind of closed, so a lot of plans to grow in the U.S. I think were kind of pushed out, and it's hard to know for sure. Some of this is kind of rumors, but I think that Bitmain was basically going to nation states and saying, I've got 5 exahash of machines in the warehouse. I got to get them out of the warehouse. So you take the machines, don't pay for them. You've got cheap electricity, so that's your kind of contribution to the partnership, and then we'll take a percentage of the hash rate for ourselves. You take a percentage of the hash rate, and I think that's why we saw a lot of that growth in the back end of last year. It was basically there was just too many machines, and there wasn't enough places to put them in the U.S. And ironically, I think we're going to face that same phase here towards the back half of 2024, particularly in the U.S., because people stopped building during crypto winter of 2022. We're running out of sites with cheap energy to deploy at. So, that we have kind of these larger sites. We have a 700 megawatt site in Rockdale, Texas, and we're getting ready to turn on our 1,000 megawatt site in Corsicana, Texas. That will start off with 100 megawatts per building. There'll be 10 buildings built over the next, several years. But I think the days of these mega sites, this might be the last one that you see in the US. And mostly that's because there's such a demand for this infrastructure, not just from Bitcoin mining, but now AI and traditional data centers. We're kind of short computing power in the world. And so you're seeing everybody kind of scramble looking for these sites. But then once you find the power, you still have to build out all this infrastructure. And just one data point that I think is important, we buy these 100 megawatt transformers for each building. If you want to buy one of them right now, it's a 2 to 3 year wait list. So when I meet with a lot of investors, technically there's no barriers to entry to being a miner. Anybody can plug in a miner, but to do it at scale, the barriers or the moat are increasing because of the lack of infrastructure. And I think that's going to be, the back end of this year, you're going to see people struggling to deploy miners.
Yeah, it's really interesting what you were talking about in terms of finding cheap plugs for those rigs, call it back half of 2024. Which kind of leads into a question we were going to get into a little bit later about the demand for AI computing facilities. Now, I understand that those generally need to be in closer proximity to call it major metropolitan areas, but what's your viewpoint on there? Do you think there'll be some amount of crowding out in terms of, these facilities where you can easily energize mining rigs?
I think that I don't know that they need to be near population centers. I mean, with depending on the tier of data center that you're using, the difference between an AI center and like one of our centers, the biggest difference is uptime. So with our power strategy, we're able to adapt to what the grid is and what the power price is and be kind of profit maximalists, if you will. But if you're running an AI data center, you can't just turn on and off, right? You have to have that redundancy, that latency, which I think is the number one issue for AI. Regarding power, there's buckets of power here and there everywhere where the world in general is flush with power. We probably waste a third of what is generated. The problem is the difference in supply and demand. Like a great example is like a hydro plant, for electricity, the water flows 24/7, but consumers have different demand cycles. We see this in the solar companies. It's called the duck curve, where everybody gets up in the morning, they make breakfast, they're running the dishwasher, getting the kids ready for whatever, going to work, and then demand drops, right? Right as the sun comes on, you get all this supply. So you have a lot of cheap power during that phase. And then conversely, everybody goes home from work right as the sun sets. And so that supply comes off the grid at the same time that demand spikes. And so for us in Texas, that's really a great part of our energy recipe, if you will, because we can adapt our operations to the price of power. And since we have long-term fixed price contracts, we can turn off and sell that power back to the grid, which has been a big thing. So AI is not going to necessarily be able to play that part of the market. We just saw Amazon buy a huge site near a nuclear power plant in Pennsylvania for $650 million, because nuclear is, again, one of those that's 24/7. but yet we'll have times of the day where there's demand and then there's no demand. So I think we're going to need more electricity generation in this country. Texas just passed a bill where they'll actually loan you money to build generation in the state. It's a 60-40 split where you have to come up with 40% of the equity and they'll loan you 60% to build. And we're starting to see things like that. For us, that's great in Texas. But on the AI stuff, we're not an AI company. We're Bitcoin. We're good at what we do. We don't have any plans on getting into AI. But the competition for these resources, we're all in the same playing field.
So let's talk a little bit about your portfolio, your mining portfolio. For investors that are perhaps less familiar with the story, what are your key locations, sources of power, and what do you see within your portfolio that's a competitive advantage?
Sure. So in May of 2021, we purchased a facility in Rockdale, Texas. And the reason it's located in Rockdale, Texas, which is about an hour northeast of Austin, is it was the former site of an Alcoa aluminum smelting plant. And you see this theme in Bitcoin, basically old industrial areas where that industry is shut down. They've left behind a lot of infrastructure that you don't have to rebuild. So our facility sits directly across the street from a 5,000 megawatt switch yard, which is one of the biggest switch yards in all of Texas. And so that's our first location. When we bought it, it had 3 buildings with 300 megawatts of capacity. We built 4 additional buildings, taking it to a total of 700 megawatts of capacity. And that right now is our only site running, and we're running about 12.4 exahash of computing power. We've got some plans to grow that to about 15 this year with some new miners coming in to replace some old miners and some expansion plans. And then our second site, which we purchased the land in the second or third quarter of 2022, so almost 2 years ago, we bought 275 acres for about $10 million in Corsicana, Texas. This is an hour south of Dallas. So again, kind of in the same geographical area of Texas in the middle, which is important. I'll tell you why. But we bought that one as a greenfield expansion, and we spent the last year and a half, 2 years basically moving dirt, building drainage, building internet, building electrical, and now building these buildings. And the first building is set to energize here in the next 30 days. And each one of those buildings, given the latest and greatest kind of mining equipment that we're buying, will add about 4 exahash. So we have a path to add 40 exahash of growth over the next 2-3 years, which is rare in this industry where a lot of players have small 20 megawatts here, 50 megawatts there. The reason that we are in the central part of Texas, both in Austin and Dallas, if you think about the map of Texas, is that the Texas grid has grown substantially over the last decade, mostly with wind power, which is in the west side of Texas. Well, most of the population in Texas lives on the east side of Texas. Think of Houston, the port cities, all that along the water. So the problem that Texas has is they have all this abundance of electricity out on the west side, and they don't have the transmission lines to get that energy to the end user on the east side. So we sit right in the middle and basically are able to absorb a lot of these cheap molecules, if you will, due to the emergence of wind power.
Yeah, very good. And I guess when you're looking at when you're looking at that portfolio of miners and you're comparing yourself to other mining firms, what are some of the internal efficiency metrics that you look at? What should investors be focused on? Is it joules per terahash? Is it coin per exahash?
Sure.
What are you focused on?
So I'll kind of rank them in importance to your cost to produce, because in a commodity business, being a low cost producer is really your only advantage, right? If you can be the lowest cost producer, you get the highest multiple in the group, you can raise more capital, you can go faster, and get those economies of scale. So power is the number one cost in mining. You can have older machines and low cost of power, and you can still make money. If you have high cost of power and new machines, you could still struggle. So the beauty of Texas, because of the size of the grid, and I'll give you some numbers, the grid is about 120,000 megawatts of installed capacity. about 35–40% of that is wind and solar, which is intermittent. The rest is natural gas, coal, with a little bit of hydro. An average day in Texas uses about 50 to 55,000 megawatts. So there's double the installed capacity of an average day use. But on the hottest days in the summer, we set a record this July, we hit 84,000 megawatts. So if you do not have the wind and the solar operating at maximum capacity during those peak demand days, that's where you get these crazy energy prices. And so what we do is we go out and we buy long-term PPAs, purchase price agreements with utilities directly, and we buy power, in the 40 to 50 megawatt kind of range. And then when we have these events that occur because of supply and demand imbalance, power prices might spike to as much as $1,000 or $2,000 a megawatt. And so what we do on those days is we curtail our production and then sell that power. So last year, using that strategy, we had an all-in power cost of $22 a megawatt. If you were just buying power as an industrial user in the grid last year, you would have spent about $35 a megawatt hour, not having the hedge, not having this ability. So this kind of recipe, if you will, or energy strategy has really led us to be one of the lowest cost producers from an electricity standpoint. So that's number one. Number two is, as you alluded to, is your machine efficiency. So right now we're in the mid 20s, 25, 26 joules per terahash. A joule per terahash is basically taking the machine's computing power and dividing it by its energy consumption. And as machines become more powerful, mostly due to thinner chips going from 10 nanometers to 5 to 4 to 3, as chips get thinner, they become more powerful and they use less power. And so we're now in the next phase of machine design, where some of the machines that we're ordering are sub 20 joules per terahash, where 2 years ago, the best machine was 30 joules per terahash. And so you're basically, your efficiency then leads to your cost at the end of the day, because you're getting more Bitcoin using less power. So those are the first really two big, kind of metrics. The last one that you referred to is your uptime or your operating efficiency. That can vary from miner to miner. Riot tends to have a lower uptime because of our power strategy. So when we curtail, we're not mining. But if we're making more money selling power, it's kind of a give one way or the other. The second thing that we face because of being in Texas is we have extreme heat, right? And so the first generation of mining was predominantly using air-cooled buildings, which is where you place the miners on these large racks like server farms, and you're using the internal fan in the miner to cool the chips. Very similar to the fan on your laptop. We've all been there when our laptop starts running really heavy and loud. It's very similar, except a miner has basically a kill switch in it. When it hits a certain temperature, it will shut itself off so that it doesn't burn out. We've experienced times in air-cooled buildings where and specifically with certain miners that we've bought, where they time out for maybe 30 or 40% of the day when it's that extreme heat kind of hits. So one of the things that we've done to remedy that is we built 2 immersion buildings, which immersion, we believe in Texas at least, is the future for mining. An immersion application, instead of stacking them on the wall and using the air to cool them, we actually take the miner and we submerge it into what in effect is a large bathtub that is filled with a dielectric fluid. It's a mineral oil, kind of like a Johnson's baby oil, if you remember those days. It's a food grade quality oil, so there's no carcinogens. But that oil, the machines actually sit in that bathtub of oil. It's non-conductive, meaning you can stick your finger in it while it's running and you don't get shocked. What we do with that oil is it goes through a heater treater, and a heater treater is basically a machine that has a metal plate running through the middle. The oil, the cold water runs on top of that plate, transferring the cold through the plate, and then the hot oil runs on the bottom and it cools that oil. And so it's a closed loop system where that oil constantly rotates, almost like an infinity pool, if you will, and goes into the tub through the bottom. And as the heat rises, it populates through the machine, and then it tails off into a closed loop system and runs 24/7, keeping that fluid and that machine at a constant temperature. The benefit of doing that is threefold. The first one is we don't have to replace fans, because fans are the number one fail safe on a miner. So we have less maintenance, less downtime. The second is that by having those machines in that steady state of temperature and running 24/7, we believe will extend the miner life. So air-cooled miners last about 4 years. We think with immersion, we could be approaching 8 to 10 years. So from a return on capital and a reinvestment cycle, we can extend that and get a greater return on that. And then the third is we can run different software that's called firmware, where we can actually run the miner at a higher latency, or I guess a higher computing power, if you will, than it's programmed for. And because when you run the computers faster, they get hotter, but since we can cool them, we can control that environment and actually get more Bitcoin out of that machine. So our facility at Corsicana that we're building today is 100% immersion. And I don't think going forward, we will go back to air-cooled, because we're seeing really good results with it.
Yeah, I had the opportunity to tour an immersion facility last year. It's really interesting technology, and what's great about it is it's fairly straightforward. It works similar to like an oil cooler on a race car, right? Very kind of simple, simple but effective tech that shouldn't really encounter many problems, and it keeps the miners very clean, right?
Yep.
So if you're out in Texas, you don't have to worry about all that Texan dust blowing in through the
Yep.
fans in your air-cooled building, right? It's impervious to that. So thank you for that color there. I guess broadly speaking, and as you're looking at the industry, there is call it a move toward vertical integration, toward asset heavy, away from asset light, so that miners can have more control over the rigs. Just call it from 30,000 feet. Do you think that trend is gaining momentum, or do you see a place for asset light miners, 3-4 years from now?
So I think if you're going to be a low-cost producer, you have to own and operate and be vertically integrated. If you use a third party, they're going to charge a fee, right? So you're already at a disadvantage to somebody that is a low-cost producer. Now, if you're super bullish on Bitcoin, I mean, and we're probably one of the most bullish, you can still make money, outsourcing it. You're just not going to get the same multiple that the bigger miners get, and you're not going to be able to grow at the scale that we do. So just if you're using somebody else for your hosting, and if they're also mining for themselves and something breaks, who gets priority, right? So your downtime could be more, your cost could be more. You can't do some of the innovative things that we do with the energy market. We had hosted clients, and they don't share in those profits when we sell energy, right? So now I think there's always going to be a place in the world for hosting. Again, it's going to go down to your cost of capital, your electricity expenses, how you design those contracts. We've just seen in just the last 3 years the difference in hosting contracts. People thought it was going to be like a data center business where you're going to get this high multiple on this business, but unfortunately, you're taking the same commodity risk as a self miner. And so if you go through a crypto winter, and what you're charging your client is more than what the price of Bitcoin is, then you put your client out of business, right? So it's like owning a hotel and raising the rate of the room, and the guy doesn't have a job to pay the bill, right?
Yeah.
So you're taking client risk. At the same time, you're not getting the upside. If Bitcoin goes to the moon, you still have a fixed margin. So we have decided to exit the hosting business. When we bought the Rockdale facility, we had 3 clients. And we're just about done with it. The last client, unfortunately, we're in some legal stuff with them, and so it'll take some time with the courts, but I don't anticipate us expanding the hosting business going forward. We're going to stick to what we're good at, and that's the self-mining.
Yeah, that's understandable. And within our coverage, we certainly favor, call it vertically integrated, asset heavy self miners. So final question, and thank you for being so generous with your time.
Yeah.
And this is it's a pretty straightforward yet somewhat loaded question. Hodling, what do you think and why?
Yeah, so we've been through kind of three phases. The first phase in the company was hold every single Bitcoin we mine. Then as we grew, our expenses grew. And the industry kind of changed a little bit. So we kind of went to a hybrid model where let's sell enough Bitcoin to cover our operating expenses, raise capital through the equity markets to grow, but cover operating expenses. Now we're kind of in this a new phase is what I want to say. So we made a decision at the beginning of this year, given the ETF approval and given the halving, we became even more bullish and we decided to hold all the Bitcoin that we mine. We now have over 8,000 Bitcoin on the balance sheet, which at today's number, is over 500, almost $600 million on the balance sheet. We're still internally debating what model we're going to do post-halving. We think if you look at like the MicroStrategies of the world, they're borrowing money to buy Bitcoin at one less than 1%, and they're being rewarded for it. We want to own as much Bitcoin as possible because we're super bullish on it. So we're going to have to figure out the balance between raising equity and holding Bitcoin. But I think in general, we see a world where we own more Bitcoin. It builds value for our shareholders. And I think at the cycle that we're in, it's very similar to my days in oil and gas, where you're basically being rewarded by the market to grow as fast as possible right now. At some point in this cycle, it might not be in this 4 years halving, it might be in the next 4 year halving. You'll get to a point where the price of Bitcoin is generating so much cash flow that investors are going to reverse that mentality and say, okay, we want return of capital now. Are you going to start paying dividends? Are you going to start buying back stock or whatever? I don't think we're there yet. I think we're still getting paid to grow. And so until we see that, switch, we're being basically rewarded to grow as fast as we can. But I could see a point in the future where, we've got so much Bitcoin on the balance sheet, we're generating so much cash flow that switches and the dynamic becomes, a return of capital to investors. And we'll respond to that market when it gets here.
Great. Well, we have several very exciting weeks ahead of us as we approach the halving, and thank you for carving out this time to discuss the company.
Cool. Yeah, Brian, I really appreciate it. And we're always available if you or any investors have any questions, just hit us up.
Excellent. We'll be happy to have you back again soon.
All right, thanks.